Good afternoon, good morning, good evening, everyone, depending where you are. Welcome to today's Future of Financial Information webinar. My name is Michał Zieliński, and I'm the host of the series. And today, it's my great pleasure to welcome Eric So from MIT, our presenter, as well as Eugene Soltes from Harvard, our discussant. So it's an all Boston affair. The topic today is going to be investor meetings and how do they matter for companies and for their stocks. So it has information in it. It has a nice, unique data set. So it basically ticks all the boxes for this theme and for this webinar series. So I'm really looking forward to the presentation. Just basic housekeeping. So Eric will present for about 30 minutes. Then Eugene will give his discussion for about 15 minutes, and we'll spend the rest of the time with the Q&A. But if you have a question, you don't have to sit on it until the very end. You can post it in the chat, and I'll be keeping an eye on the chat, and I'll make sure to call on you when the time comes for Q&A. And so the webinar is officially over at 5 p.m., so on the 1 hour mark, but we will stick around for some time for informal chat. So feel free to do that too, and talk more about this exciting paper. And so now, without further ado, Eric, the screen is yours for 30 minutes.
Great. Thanks so much. And thank everyone for the opportunity to present. So some new research that I'm co-authoring with my esteemed colleagues, Rongfei, Wang, as well as Zhang, who I believe are on this call. I also want to extend my heartfelt thanks to Michael for organizing and selecting such a great discussant for this paper. Eugene is not only an expert in the field, but a close personal friend of mine. So I was very excited to see his discussion. So just a little bit of background. The motivation for this paper really came about as part of a broader research agenda that seeks to help bridge the gap between the theory and the reality of arbitrage or active investing in practice. And so if you look at standard textbook definitions, they typically characterize arbitrage as some sort of clear deviation between prices of identical assets or of market prices from fundamental values of the assets. In reality, many of the folks that we characterize as arbitrageurs, like say, for example, a hedge fund, face the need to estimate expected returns based on a host of noisy signals. And so part of what we're going to do in this paper is to try to shed light on this estimation process. In particular, we're going to focus on characterizing how investors form expectations over future returns, as well as the multi-stage process that gives rise to investors' portfolios. So in some ways, this paper is an attempt to really kind of open up the black box to say what's going on within the minds, within the practice of active investing, and what can we learn from that behavior. So I teach a class at MIT on active investing. And I typically start with the following chart, which harkens back to my prior time spent working for a discretionary investment fund. And when I talk about what we did, I typically start with the following chart. I mentioned that we worked within US equities. And so we started out with a stock universe of roughly 5,000 firms. And then what we would do is we would get that universe down to what we call the investable universe. That is, we would impose some minimum liquidity requirements and perhaps a targeted size profile to get away stocks that were actually something that we may want to trade in. From there, what we would do is we would rank stocks on the basis of several quantitative stock selection signals. That is, we would kind of rank them on, for example, on the basis of past returns. And then we would look for stocks that appear attractive on the basis of those quant rankings, for example, the very extremes of the portfolios. That would get us down further. But once we were down to these sort of extremes of the portfolios, we wouldn't just stop and look at the top and the bottom, as is often depicted in academic research. Instead, what we would do is then go into a deep dive, where we would have analysts within the firm prepare research reports and kind of do due diligence to understand if the signals that we're observing are really indicative of some sort of mispricing. And from that list, once we put together a deep dive in these detailed reports, we would ultimately form a portfolio that was approximately 25 long positions and 25 shorts. Now, I realize that this particular structure may not apply to all firms, but for most discretionary investment funds, there's an intermediate step, in which case we kind of do research to figure out what are the stocks that we should be ultimately buying or shorting or selling or betting against. And so part of what I'm hoping to do in this paper is really to start this process or contribute to our understanding within the academic literature of how fund managers actually form their portfolios. What's going on in that intermediate step as they transition from quant signals to ultimately to a portfolio. And the way that we're going to do that is we're going to look at it through the lens of investor meetings. And this is why I was really excited to have my good friend Eugene discuss this paper, as he's done a lot of the pioneering research in this field. And in case you guys don't know, what Eugene and others have pointed out is that in-person meetings between an institutional investor and a firm are a pervasive, common feature of modern capital markets. And there's a lot of things that can happen at these meetings, but one that we're really focused on or thinking about are cases where investors travel to firms' headquarters or their plants to speak with firms' management, perhaps just to get a sense of where they stand, kind of look them in the eye, and gauge their ability. They're also going to observe potential prototypes if one exists, thinking about how far along they are on projects that they're developing. Or perhaps it's really just to inspect production facilities to understand if the production is running as smoothly as they may hope. And my entrepreneur co-authors were really wanting to understand this, this process at a deeper level. And so they had interviews with a couple fund managers who spoke about what was happening during these meetings. And what the fund managers reported was really kind of intriguing, at least to me, which is that for the fund managers they spoke with, they spent roughly half of their work hours visiting firms. So imagine that the average fund manager works 60 hours a week. They might spend 30 of those hours visiting companies on average. And what was really striking about this is that these meetings commonly occur without investors even owning the shares yet. So you may imagine or think about it from a governance perspective where an investor will go visit a firm and simply make sure things are running well. But what we find evidence of, which corroborates some of the interviews that my co-authors conducted, is that this will often happen even before the firm, the investor owns shares in the firm. This is also really striking or notable to me, because if you think about what's involved with these meetings, they impose both direct and indirect costs. The direct costs come in the form of things like employee salaries or travel expenses. That is, to go sort of look the manager in the eyes and look at their facility, they actually have to travel. But there's also indirect costs in the form of potential price slippage or foregone investment opportunities. That is, as you move from these quantitative stock selection signals to the ultimate portfolio, the time required to go meet with an investor or meet with a firm is potentially a loss to you in terms of your investment position. And so really what we're focused on in this paper is, given these costs and the large amount of time spent visiting firms, what can we infer from investors incurring these costs? That is, what does that tell us about the firms that they're visiting? And to get some sense of how to answer this question, I also kind of harken back to my life growing up before the internet really took hold, before there was YELP. And so I remember going around with my parents and looking at restaurants, trying to figure out where we should eat. And of course, you can kind of look on the outside windows and see the menus and take a look at the prices. But another thing that you may take a look at is just how many people were located within a restaurant. How much business do they seem to have? And so what I have here are two pictures of two restaurants in the north end of Boston. And so if you look carefully at the one on the left, you may notice that there's a lot of folks standing outside. This is a very popular restaurant in the north end. And I would characterize this as a high cost option if you wanted to eat there, because if you wanted to, you'd have probably a long wait time. And from the fact that many people are waiting outside, I think a reasonable inference for this is that this is more likely a good restaurant, conditional upon the price. Whereas the picture on the right, given that there's no one there sort of eating there, it's a low cost option. And the fact that it's empty tells me that it's less likely to be a good restaurant. And so building upon this type of intuition, what we're going to do is try to apply the same sort of concept of cases where it looks like investors are really incurring high costs to understand what that tells us about expected stock returns. And just to give you a sense of where the paper's going, of what we find, the title of this paper is really a reflection of this like market for meetings. That is, like, how do we think about market clearing in a case where the meeting itself imposes some costs? And what we predict and find evidence of is that abnormal meetings, that is when the firm has a lot of investors visiting them, they signal the rewards that help compensate for the time, the travel, the attention that fund managers spend on a meeting. Otherwise, in the absence of that, we might not expect that investors would be willing to make that trip. So what we find is that investors' decisions to hold in-person meetings with firms signal expected returns. And in particular, when there's a lot of abnormal meetings, it tends to signal underpricing, which is consistent with the long bias in fund holdings, that the funds tend to be more long than they are short. Our main findings, just from an empirical perspective, are that firms with many, abnormally many investor meetings outperform firms with abnormally few. And I'll characterize this as an economically large predictable pattern in returns. And so when I talk about a return strategy or that it's economically large, people, I think, naturally and understandably gravitate towards this idea of like, what is the annualized return? How much could be earned over the course of the year? And on that basis, what we're going to find is that the strategy earns about 70 basis points per month or about 10% per year. But in addition to this annualized piece, what we often talk about or sort of preach, thinking about the economic significance of a strategy, is also the strategy's breadth or its capacity. The breadth refers to how many stocks that this can be applied to within a given cross-section, such that it's amenable to layering strategies or potentially multiple types of size profiles. And also its capacity, that is a strategy's ability to sustain a lot of weight. If you were to contribute more money, does it still hold up? And so we're going to provide evidence that it's also, it works very well when value weighted, when applied to larger stocks, but also that it's persistent in the sense that the return prediction signal lasts for a while, suggesting that it doesn't have a very high level of turnover. So we consider these pieces what we call the ABCs of economic significance, the annualized returns of breadth and capacity. And I mention this because along all of these dimensions, the strategy seems to work quite well. All right, so here's a case study that my co-authors put together of a company called Center Testing International, which was a firm that put out some earnings guidance in February 2018. And they mentioned one thing that was really notable about the guidance was that it seemed pretty positive, that on most dimensions in terms of operating revenue or income, the company was poised to improve. Well, this caught the attention of a fund manager at a fund called Bocom. And in March, the Bocom's fund managers that we spoke with were really struck by the fact that they had this very optimistic forecast against the backdrop of what were pretty dismal trailing stock returns. And I'll show you a graph of that in a bit. So based on the industry outlook, as well as these like much higher price to earnings ratios for comparable international firms, Bocom decided to visit CTI, that is the firm, to better understand what was going on. And Bocom noted three takeaways from the new chairman, which is when they had the ability to kind of look the new chairman in the eye, the new chairman really conveyed this seemingly sincere sense of regret to see the company that he had taken over from his father a couple years ago fall from grace. The stock price had fallen precipitously. Part of the reason was allegations that the new chairman wasn't really serious about the company. At the same time, the chairman committed his full focus until he could find a proper CEO that wasn't sort of direct lineage to the founder, and also outlined some promising strategies to include, including restructuring and M&A. So it gave some sense into where the company was going. So what I have here is a graph of CTI stock price, starting back in 2015 when the new chairman sort of took over. And what you notice is that the stock price fell pretty far, from a high of $40 to about less than $5 in March of 2018, which is when CTI first visited, or BOCOM first visited CTI. After that meeting, BOCOM added CTI to 3 of its funds, and over the next 3 years earned a return of roughly 350%, okay, suggesting that they garnered from that the stock was undervalued. What was also really notable about this graph is that during this time frame, when CTI put out its guidance and BOCOM visited, BOCOM wasn't the only fund to visit CTI. Instead, it coincided with a surge in abnormal visits from many investors. So what we're going to do in this paper is really kind of expand this case study to think about whether these surges in abnormal visits coincide with underpricing, such that it's indicative of expected returns. And the way we do this is we gather data on companies' investor meetings with companies listed on the Shenzhen Stock Exchange. And what's really nice about this is that all companies on that exchange are required to provide very timely disclosures of not only the date, but the participants of that meeting. And we take that list and kind of cull it down to stream out things that we don't want or we don't think are informative of these, like visits to travel to meet with companies in person, things like press conference or media interviews. We also get rid of cases where they're not really incurring a lot of costs, like phone calls or emails. And we also delete meetings that appear to only involve firms and sell-side analysts to look for cases where firms are actually sort of identifying or reaching out to meet with investors and vice versa. And so our final sample consists of roughly 100,000 firm month observations spanning from October 2012, when this data first became available, until December 2019. And so just a couple things to note, which is this is figure 1 of our paper, showing that these meetings often are reported on a very timely basis, which is nice from a variety of perspectives. The companies on the Shenzhen Stock Exchange are required to disclose the date and the participants of these meetings within 2 days, and the vast majority seem to comply, suggesting that it's a timely bit of information. In terms of the composition of these meetings, this is figure 1B of our graph, and what it shows along the y-axis is just the share of our sample, and along the x-axis here is the number of visitors that attended a given meeting. And so what we find is that the median meeting where a firm hosts investors reflects or involves 4 institutional investors. And as we see, I'm not sure I'll have time to show it, they commonly occur prior to owning the shares. That is, that funds will often visit even though they don't have ownership yet. But what we're going to focus on in this paper are abnormal meetings, cases where there seems to be a lot of meetings that don't seem to be explained by the firm's profile. And let me explain that in a bit more detail. So what we're really interested in is this sense of abnormal meetings and the fund manager's expectations of performance. The problem is the raw number of meetings between a firm and a set of funds reflects multiple drivers. That is, we think about it as some reflection of observable characteristics, but also this expected performance piece that we want to capture. And so to try to capture this expected performance piece, what we're going to do is run cross-sectional regressions. They regress the number of meetings on a set of basic characteristics that capture a firm's, their size, liquidity, and past performance profile. And what we're going to do is we're going to look for cases where there's a lot of meetings, despite the fact that the company, despite how it looks in terms of how big it is and how liquid it is, and perhaps a surprising number of meetings. And what we're really interested in capturing is these cases where there's either a lot of meetings that seem kind of abnormal relative to the firm's size, or perhaps too high or too low. And we're going to form portfolios on the basis of what we call AIM, abnormal investor meetings, which just represent the error term from the regression listed on the slide. Now, of course, this is a simplistic model. It's one that I've used for another paper that I've written, but it trades off parsimony for comprehensiveness. There's a lot of things you can think about incorporating into this regression, but we're going to show you that the results are not particularly sensitive to this formulation, and instead really focus on the fact that the error term from this very simple model seems to do a good job of forecasting future performance. And so the thing to take away from this is that higher values of AIM tend to signal abnormally frequent or numerous meetings between a firm and investors. And so what we're going to do is we're going to rank firms into the cross section, and this is on the basis of AIM. And so what this chart or this table represents are returns of different portfolios sorted into quintiles on the basis of low AIM, which corresponds to abnormally few meetings, or high AIM stocks, the ones with abnormally many. And when we rank firms on the cross section each month and look how they perform in the subsequent month, what we noticed is that high AIM stocks predictably outperform those with low AIM stocks. That is, they tend to earn high returns of roughly 114 basis points per month on an equal weighted basis and about 65 basis points on a value weighted basis. And so these tend to be economically large, roughly 14% or 8% annualized, and they seem pretty robust across a variety of standard asset pricing techniques. So it seems consistent with our sort of main hypotheses. We find that if you look at this chart, which is figure 4, it talks about sort of the average return for different years in our sample. This shows simply that the average return tends to be positive. It doesn't make money every year, but the results are not sort of driven by one particular time period. We also find that when we do these sort of multivariate regressions, where you can think about controlling for other factors known to explain the cross-section of returns, what we find is that the level of meetings in and of itself, which is column 1, doesn't seem to predict returns. And this is consistent with the idea that some of the variation in the amount of meetings is just driven by the fact that some firms are just big and they naturally attract attention. But once we sort of strip out the piece that's not attributable to their size or liquidity profile, we find a very robust positive relation between AIM and future returns. We also find some evidence that is distinct from things like abnormal analyst coverage, which tends to be associated with future performance. It doesn't seem to be driven by the returns that are concentrated at the time of the meetings. It also doesn't seem to be explained by levels or changes in institutional ownership, meaning that it doesn't seem like this is just some upward price pressure that happens in stock returns as institutions are buying in. Okay. The last thing I will say about this, just from like the main result perspective, is that the portfolio return, the return prediction seems to last a while. In that if we look at equal and value-weighted returns, what's plotted along the y-axis here are the hedge portfolio returns, and along the x-axis is the time horizon over which we measure abnormal meetings. And so the further right you move on the graph, the longer is the delay between when we measure AIM in the return period we're trying to forecast. And so you can interpret the blue bars as saying from an equal weighted basis, the AIM strategy, the AIM signal forecasts returns for up to 9 months in advance, suggesting that there is some long-term predictability. The red bars indicate that on a value-weighted basis, the signal works for roughly 5 months. And we also find no evidence of a reversal, suggesting that this is a more persistent effect. Okay, the fact that it predicts returns, we then sort of look conditionally. And what we find is that this is a double-sorted strategy that looks not only on the basis of AIM, which is listed along this top row, but also on the basis of this variable called ATOT, which is abnormal total analyst coverage. This is from a different paper that I wrote. But one of the things we were worried about is that this predictability only reflected perhaps institutions' free riding on analyst behavior. And instead, what we find is a complementarity here, in which case, when there's abnormally high levels of an analyst meeting, as well as high levels of AIM, as depicted in the right blue square, we find much stronger predictability. In fact, this combined strategy works really well. It tends to double or significantly increase the overall performance of this strategy, suggesting that analysts and institutions kind of play distinct roles in helping to uncover underpriced firms. Now, what we do next in the paper is really think about some mechanism tests. One of the mechanism tests that we consider is the role of capital raising, which Eugene has nudged me before on, which was very helpful in thinking about what role it plays if firms are the ones who are seeking out attention from funds. And so we tried to figure out if that was something going on in the paper. And so what we did was we sorted firms into quintiles based on AIM. And then we kind of looked for what was happening in the firm. Does it seem like it correlates with attention-seeking behavior? As if the firm were reaching out to investors to say, hey, look, I'm underpriced. Please come visit me and bet on me. And so when we look at things like changes in disclosure, this DISC variable, or the repurchase activity, we don't find much activity suggesting that high AIM stocks are doing anything sort of out of the ordinary, either in terms of like issuing press releases or guidance to garner attention or repurchasing shares in an abnormal way. We also don't find any evidence that the companies that are subject to a lot of these meetings have abnormally high accruals. That is, it doesn't seem like they're managing earnings in a way that would suggest that they're engaging in capital raising. We also ran one additional test that didn't make it into the version of the paper that we posted. But we also looked at things like external financing, whether high AIM stocks are any more likely to be raising capital if we look at cash coming in from external investors, either in levels or changes. We didn't see any positive relation between AIM and external financing. And this told us that it doesn't seem very consistent with the story in which firms are seeking out attention. Perhaps that's still going on in the background, but the data doesn't seem to strongly support that as the first order effect. We also look at some variation in the cost of holding meetings. If you recall, the title of the paper is Meat Markets, because we're kind of thinking about the clearing for these costly meetings and making sure that firms are compensated when they're engaging in greater costs. So one thing that we noted that was really interesting is that when we took a look at mutual funds and their positions prior to visiting companies, what we have here plotted along the y-axis is the percentage of what we call unhold, which is just a dummy variable if the visiting mutual fund owned shares before visiting the company. And what we have plotted along the x-axis are quintile portfolios of AIM. And what we noticed is that for many of the funds visiting companies, oftentimes the funds did not own shares prior to investing. And this was really striking to me because reaching out to sort of engage managers to make that initial trip suggests that they're incurring greater costs. So what we do in the paper to try to figure out if this sort of meat markets clearing explanation is going on is we looked at the strategy, their performance, in cases where there's a lot of investors meeting for the first time versus not. And what we find is that in table 7, panel A, is that the predictive power of AIM for future returns really concentrates in cases where the visiting fund doesn't own shares yet, or where they're sort of initially meeting the company. That is, it's not part of a routine visit. They're doing it for the first time. And it's consistent with institutions earning higher expected returns when incurring greater costs. The last thing I'll show you is just a mechanism test that talks about future fundamental performance. In particular, in my own experience working for a fund, seems to corroborate fairly well with what we're seeing empirically here. So what we're doing is we're looking at the relationship between AIM, that is abnormal investor meetings, and the firm's fundamental performance, that is like their earnings performance, reported at their next set of earnings announcements. And so we run these regressions towards the back end of the paper that measure things like their standardized unexplained earnings, that's the SUE, as well as the analyst-based forecast error and revisions. And we see a very strong, robust, positive relation between AIM and these subsequently reported metrics of fundamental performance. This suggests that part of the way that funds are identifying stocks that are likely to outperform in the future is by forecasting their fundamental performance and scheduling visits to ascending firms. And so that's what we think is part of what's going on here. So I can tell that I think I have just a minute left. So let me just wrap up with sort of like a personally branded slide, a conclusion slide called Eric, so what, so what's next? In terms of so what we find is that investors disproportionately allocate attention to meetings with underpriced firms. We think this is a helpful way to uncover what's going on in terms of the black box and the transition from quant signals to an ultimate portfolio. It also highlights the usefulness of investors' resource allocation decisions, where we're kind of following what smart money is doing and figuring out what can we infer from that. It also provides insight into the multi-stage process that investors undertake when forming portfolios. We think this is important because if investors are taking the time to frequently travel to go meet with management before they actually take investment positions, this suggests that one of the reasons that quant signals take some time to be reflected in price is simply because investors engage in this vetting process in which they want to go meet with firms' management to figure out if it's worthwhile. In terms of what's next, there's still a lot to do both in this paper and in this space. I think there's a much better need, or there's a need to better calibrate the costs that the companies are incurring, thinking about how much time they're spending within the firm and what that means for the performance of the funds they're visiting. And I think one of the tests that's really at the forefront of my mind is thinking about extensions to the fund's performance. That is, once the funds are incurring these greater costs, does that seem to benefit how the fund performs overall? And is that offset by higher fees? We're going to think about the sort of the market for funds that visit. And I think there's a lot more to do in this space. So with that in mind, I will pause there.
Thank you, Eric, for this perfectly timed presentation. I'm going to stop the official part of the webinar here. And in the meantime, let me just announce that the next webinar will be in 2 weeks on March 10th, same time, 4 p.m. Central European time. We will have Clifton Green from Emory with a very sort of topical paper on retail investor trading in this a new version of it through Robinhood and similar apps, and what is that doing to the markets. So check out the schedule on the website and register. And if you need to take off now, then thank you very much for participating, and see you next time.